All right, guys, let's quickly take a look at that upcoming US jobs report we've got scheduled for 1:30 UK time or 8:30 Eastern time. Now, this thing can create a lot of volatility today. I know, markets always freak out about NFP and they always try to make, every NFP report the most important NFP report ever. But this time around, this thing can really create some additional volatility, at least more than what we used to. Because we know over the course of the last few weeks, the markets have been incredibly sensitive when it comes to US economic data. And the reason for that is, remember, over the course of the last, from the start of the year, basically, we've had that US exceptionalism theme that kicked in, right? Where the data was super strong versus anybody else. And what we've seen over the course of the last let's call it 4 or 5 weeks now, we've had that continued stream of downside surprises for economic data. Yes, we've had some upside surprises here and there. I mean, case in point, ISM services a little bit earlier this week. But for the most part, the trend in the data suggests that we are either seeing a very short-term soft patch or something that could potentially last a little bit longer. And that is why this data will be a little bit more important than usual, I would say. Now, again, take that with a pinch of salt because, as a market analyst, we always try to, every event is exciting, if that makes sense, because we geek out on this stuff. But I do think this one, from a tradability point of view, can be a little bit more interesting than usual. Now, something to always keep in mind when we look at something like an NFP print. Don't be the guy that only looks at the headline NFP number, right? We can't just look at headline NFP because we are looking at the jobs report as a whole. That means we don't just look at headline NFP, we also look at the unemployment rate, we also look at average earnings month over month and average earnings year over year. These 4 things, these 4 key measures makes up the jobs report. We can't just fixate on the headline number. If you trade the headline number by itself, you're going to get into trouble because what normally happens, you get that first bout of volatility coming out of the NFP number itself, but then very quickly the markets will turn their attention to the unemployment rate, turn their attention to wages. And if these things paint a vastly different picture than what the NFP number shows us, the markets can actually discount NFP and trade in line with those other measures. It's happened many times before, so just be very wary of that. Don't just look at headline. We look at all 4 measures, and we'll go through that in a second. Now, in terms of tradability, I think whether we get a decently enough dovish or decently enough hawkish print to trade today, I would look at both of them as very short-term scalp risk event opportunities, nothing more than that. The reason for that is twofold. Firstly, we have seen a chunky amount of pre-positioning for the dollar and yields and equities coming into this already. I mean, if you take a look at the dollar, we are trading very close to recent lows. Yields are trading very close to recent lows. Equities trading very close to recent highs. So the markets are already priced for a potential dovish NFP here, right? Meaning that if we were to get a dovish outcome, because the markets have already seen a fair bit of pre-positioning, I won't trade a dovish surprise as anything more than a short-term risk event scalp, given that pre-positioning. On the other side of the coin, because I think the path of these resistance remains higher for equities, remains lower for yields, remains lower for the US dollar, I wouldn't want to trade a hawkish print as anything more than a short-term scalp either. Because I do think the markets will be able to discount any type of stronger number, just like we saw with the ISM services PMI a little bit earlier in the week. So bottom line, whether we get a dovish or a hawkish enough surprise to trade out of, I think short-term risk event scalps for both outcomes makes the most sense here from a tradability point of view. So let's take a look at some of the numbers then. What are markets expecting from this? Markets are expecting a little bit of a move higher for headline NFP from 175 to 185, minimum sitting at 120, maximum at 258. For the unemployment rate, as well as average hourly earnings year over year, they're expecting unchanged prints. Now for unemployment, 3, 8, and 4 for the minimum and maximum. For year over year, very wide forecast distribution with a 3-1 low estimate and a 4 high estimate. We'll talk about that in a second. Month over month, expected to see a slight increase to 0.3 from 0.2 with a minimum of 0.1 and a maximum of 0.4. So what do we do with these numbers? Well, generally speaking, for the best bang for our buck outcome out of an NFP print, what we really want to see is we want to see all 4 of these key measures, non-farm payrolls, unemployment, month-over-month, year-over-year earnings, to show us the same thing. That means either all 4 of them missing their estimates or all 4 of them beating their estimates. Now, what we also look for sometimes is if we want to see a big enough miss, we want to see a miss or a beat that moves away or outside that range of forecast distribution range, so moves below the low or moves above the high, normally packs a little bit more punch. But something that we can do to even increase our edge a little bit more is we can take a look at what the forecast distribution looks like under the hood. And apart from that, we can even throw in some time series analysis to basically figure out what type of numbers will give us the best shock factor, basically, going into these types of prints. So let's start with something like the NFP, and let me bring up the forecast distribution here for a second. Here we go. So you don't have to be a rocket scientist here to see that anything below 140,000 or anything above 230 will already surprise the vast majority of analysts that was polled for this event, right? So anything below 140, anything above 230, that should be a big surprise. However, we can take it one step further, and we can also take a look at the time series, because if we bring up the time series for the NFP here, we can see that obviously prior was 175. But take a look at this. Apart from the negative print we had back in December 2020, the lowest print that we've had over the course of the last 3 years was that December 2022, coming in at 136. Now, I mean, 136 is super close to that 140 number that we just looked at. So ideally, for a big enough miss, for a big enough disappointment on the dovish side, we want to see a number that prints below 136. So 135 or lower will not just be outside that forecast distribution range. It will also, from a time series analysis, be the lowest employment growth that we've seen going back all the way to December 2020. Those types of things create shock factor, right? So that is what we'll be looking at for a potential miss. In terms of upside, I think 230 will do, not really from a time series analysis point of view, but because we've seen a chunky amount of pre-positioning already, I think anything above 230 might do the trick. We've also heard that the whisper number, as you guys will sometimes hear it referred to, is a little bit lower, something closer towards 160 and 170. So again, 230 on the upside, I think should be enough to give us ample amount of surprise. Now let's take a look at the next one then, which is the unemployment rate. Let's bring up that forecast distribution here. Okay, so for the unemployment rate, we have a minimum estimate of 3.8 and a maximum estimate of 4%. And we can clearly see that that 4% estimate is a very clear outlier, right? So this tells us that any print that is equal to or greater than 4% will surprise everyone polled for this except one. And when we look at the time series, we also have the added benefit that any print above 4% will also give us a bit of a shock factor, because anything above 4 will be the highest unemployment rate since January 2022, and will also be the first one since then with a 4 handle, right? So we'll be going from a 3 handle to a 4 handle. I think 4% or higher, obviously, but 4% should do the trick. That's not the one we're looking at. Here we go. Should do the trick from a surprise point of view on the dovish side. What about the hawkish side? We only have a small basket of analysts looking for a print of 3.8. So 3.8 or lower, I think, should do the trick for a hawkish or a beat, a hawkish surprise or a beat surprise for unemployment. Now, what about month-over-month earnings? Now, if we take a look at month-over-month earnings, we know that the minimum estimate is 0.1. Maximum is 0.4, but again, we can see both of these are very clear outliers, right? Which means that for a decent enough dovish surprise, a print of 0.2 normally would have been fine. But when we look at the time series, and this is where things gets interesting here again. If we took a look at the time series for month over month, we can see that at 0.2, it'll basically just be an unchanged print from the prior. Which means ideally, to really have a bit of a shock factor, we want to see something a little bit lower. So I think 0.1, even though it is a clear outlier here from a forecast distribution point of view, I think 0.1 or lower, of course, will probably be what we want to see for a real surprise there. For a beat, I don't think we have to worry too much about the time series. I think there, because again, pre-positioning is pretty dovish already, I think 0.4 or higher should do the trick to really surprise the markets on the hawkish side. So let's now take a look at average earnings year over year here for a second. All right, so with year over year, let me just quickly see. Yeah, there we go. So with year over year, again, two clear outliers here with 4% on the upside and that 3.1 to the downside. This is such a big margin between the others. I wonder whether this might have been, a finger error from the analyst. When he put in his poll, I think it might have been something, closer to 4%, because it's just such a huge difference between the others. It just doesn't make a lot of sense. But anyway, because this is a clear outlier, I don't think we need to have anything close to that to surprise. I think 3.7 will already surprise the vast majority of analysts polled for this. Now, there's something else to add here, because 3.7 would be great, but there is a chance that maybe even 3.8 could do the trick. The reason why I say that, if we take a look at the time series, anything below the prior of 3.9 will already be a new cycle low. So even though I think 3.7 would be better, there is a chance that maybe even 3.8 could do the trick, purely just looking at the time series. All right, so that gives us, and what about the upside? Again, if we take a look at the hawkish side, even though 4% is a clear outlier, all of the others are sitting very close to 3.9. So I would say 4% or higher would be good. And also, 4% gives you a little bit of a shock factor as well, because it'll be going from a 3 handle back up to a 4 handle, which should be good enough for a hawkish surprise. Now, let's take a look at a few possible scenarios then, given that we have the threshold. So we know what type of numbers we'll be looking for. What can we look to? What can we expect from markets based on this? Now, if we get the ideal dovish outcome like we just described, smaller or in line with 135 for the NFP, above 4% for the unemployment, below in line or below 0.1 for the month of a month, in line or below 3.7 for the year over year, and obviously the numbers we looked at for the hawkish surprise. If we get either one of these types of outcomes, the normal expected reaction that we would expect across major asset classes for a dovish surprise would be dollar down, yields down, equities up, gold up. The normal reaction for a hawkish surprise would be dollar up, yields up, equities down, gold down. However, right, I'm not saying I'm going to trade these things this way. This is the general expectation, the baseline expectation for the reaction function from these assets. But there's always the chance that they react differently. Sometimes you would expect ES to go up or down, and it just doesn't, right? Sometimes the dollar, you would expect it to do that, and it just doesn't do it. So this is not the way that I'm looking to trade these potential outcomes, but this is the broad expectation for what we think could happen to major asset classes if we get that ideal dovish or hawkish outcome. So assuming that we do get an ideal dovish or hawkish outcome, how can we potentially look to trade them? Let's start with a dovish one. I think the simplest way to trade this is going to be either looking for dollar shorts or T-bond longs. I just think that's the cleanest way to express that. You can also potentially look at equity longs. The only reason why I would be reluctant to trade equities on the long side is there's going to be a thin margin between what equities does with a 135 or lower print. Because the lower we go, the more risk of recession fears can start to grow, which makes me a little bit cautious of wanting to buy equities on a dovish surprise. That would have been the normal reaction, right? But I'm a little bit reluctant with that, given how low that number might be. If it's just 135, maybe equity upside could still be on the cards, but I don't think that's the simplest trade. I think the simplest trade is to look for dollar shorts on the back of that. Either looking to trade euro dollar on the long side or dollar Swiss on the short side. Why euro? Because we had the hawkish cut from the ECB yesterday. Why the Swiss franc? Because this week's CPI data doesn't give the SNB any type of comfort about where inflation will be heading next, right? So I think that could be possible opportunities to trade. Dollar Swiss franc, next key level to watch out for would be 88.50 to the downside. And for euro dollar, we're sitting at the 109 psychological now. So if we can clear that, next level to watch for would be 109.15, which is the high from the, the third, the fourth. And then we've got the highs going back, the whole series of highs really, going back to March to aim for around that 109.50. Now, the other thing to keep in mind is that we don't just get the jobs data, we also get Canadian jobs data. So if dollar data comes in really bad and Canadian data comes in really good, we can also look at some potential dollar CAD shorts, right? That could also be on the cards. We're currently trading around that 136.80. Key support comes in at 136.50. Below that, we've got the implied vol low around the 136.20, and then we've got 136 clean levels to aim for to the downside if we have that type of data divergence between the two. The other one that we can look at is T-bond longs, right? If it's a really dovish outcome, T-bone longs could be on the cards. Let's quickly go there. Levels to aim for there. We are right in the middle of that pretty messy range that we were stuck in for quite a while. So I would say next area to aim for would be 120.14. Above that, maybe 121-ish. Again, this is looking at the daily. So the problem is we'll be looking to trade this short term anyway. So a bit reluctant about this one, but it could be just like the dollar. It could be a cleaner trade to try and squeeze something out of. Now, what about a potential hawkish outcome? Now, for a hawkish outcome, again, I think dollar longs looks like the simplest way to express that. What I would look for is dollar CAD long if Canadian job surprises massively lower. So if it's bad Canadian jobs, good US data, then dollar CAD upside could be good. In terms of levels to aim for there, let's just quickly go back. In terms of levels to aim for there, we've got this whole cluster of resistance sitting around that 137.30. So that's the simplest target to aim for to the upside. The other one that I like to the downside is the Aussie dollar for the reasons that we've explained, a lot in the last 2-3 weeks now. We're sitting at nice key resistance here around that 66.60, 66.80 level. So a very strong US jobs report could see a move back down towards that 66.30, maybe 66.20 level of support. And that is the way that I'll be looking to trade a hawkish surprise. The other one that we could consider is some potential gold downside given positioning. Let's just quickly open up the gold chart here. Big amount of, reversal playing out for gold today. It's looking heavy from a positioning point of view. Let me just show you guys what I mean by that. If we just quickly bring up that CFTC data from Monday. Here we go. So CFTC saw a huge amount of long positions added. That always makes me a little bit weary when I see that type of move. It feels a little bit, it feels a little bit too aggressive. So some potential gold downside on a very hawkish number could be on the cards. Maybe a move back down towards these recent lows around 23.15. Maybe a move back down towards that 22.91 level could be on the cards as well. And we have the option skew tilted to the downside for gold as well, looking at risk reversals. So that is something that, is just worth keeping on the radar for a potential hawkish surprise. Now, let's get to the more complicated ones. A Goldilocks outcome and a recession fear outcome. What does a Goldilocks print look like? Goldilocks is when labor market comes in pretty much in line with expectations, a band between 175 and 200, something that's not too hot, it's not too cold. Unemployment pushes down to 3.8, and we've got earnings numbers coming in much lower than expected, right? The same we'll be looking for a dovish outcome. So if jobs comes in decent, unemployment comes in low, and wages pushes lower, that gives us a Goldilocks outcome. Right? When you have growth and labor pushing up, but price pressures pushing lower, that gives you a very Goldilocks outcome. What will the dollar do in that situation? It's too messy to trade, right? If you have that type of outcome, the dollar has a lot of two-way risk if we get a Goldilocks outcome, because it could be good because the fact that the labor market is solid, but if wages comes in lower, it obviously opens up some potential for the Fed to be more reluctant to cut rates. So it makes the dollar messy, it makes yields messy, it makes gold messy, which means that in a Goldilocks outcome with labor, like I said, decent, unemployment lower, wages much lower, ES longs looks like the simplest way to express that, right? Equity longs on a Goldilocks print just makes the most sense. Think back to the ISM services print that we had a little bit earlier in the week. That was all based on that Goldilocks outcome. So levels to aim for there. We basically add all-time highs, so I think round numbers like 5,400 is probably going to be a okay area to aim for. It's also in line with the implied volatility high for the day, so that is how I would play a Goldilocks outcome. I've got no interest to trade things like the dollar or yields or gold on the back of that. It's just going to be too messy. There's too much two-way risk. What about a recession fear outcome? Now, this is where it gets tricky, right? That's why I don't like equities on the long side on a dovish outcome, because if jobs comes in so bad, if we print sub 100, 99 or lower, that's going to spark some recession fears, right? At the same time, that's probably going to be enough to see, firstly, unemployment back in a 4 handle, but maybe up to 4.2%. If we then, from an earnings point of view, it's a little bit tricky to dictate where earnings needs to land to give us a recession vibe. But I would assume an as expected or slightly lower print on wages might feed better into a recession vibe as opposed to a higher number, but a higher number could also be seen as bad. But if we get a real recession outcome, so sub 100 jobs, 4.2 or higher on the unemployment, wages that comes in either lower or stays flat, I see equities to a risk there, right? Because it should be good if jobs comes in bad, because it means the Fed has a higher chance to cut, right? But if it's so bad that it paints a bad picture for earnings or for the economy, then that makes ES less attractive. Same story for the dollar. Super bad numbers should be bad for the dollar from a Fed point of view, but we also know that when we have recession fears increasing, that can normally lead to dollar appreciation. So that makes the dollar a very risky one. The only clear outcome that I can see here, and potentially gold upside, because gold sometimes do trade as a recession hedge, if you will. But if equities are going to push lower, or because there's two-way risk for equities and two-way risks for the dollar, gold can go either way, which makes it tricky. I just think the cleanest way to trade a pure recession fear outcome would be bond longs. I think that'll just be the simplest way to look for to look to trade something like a recession fear outcome. Bond longs, I think, is the simplest way to do that. The others has a lot of two-way risk. So I know that is a lot to take in, but there's a lot to go through. And again, these data points, they can be extremely volatile. So we do need to know what we are looking for. We have to have a clear plan before we go into them. Otherwise, we can run into trouble. So hope it's helpful. As always, any questions, don't hesitate to let me know.